All right, it is now 7 p.m., so let's get started. Welcome, everyone, to our 28th episode in our second ongoing webinar series for federal employees and retirees. My name is Quinn Ackerman. I'm one of the co-founders here at Parco, and I'm actually co-hosting tonight with my colleague, John Mantia. He's a co-founder and the director of finance here as well. It's great seeing all these new faces on tonight. And for those of you who are familiar, we really appreciate your patience as these first few slides always go the same way. So we are Parco. It stands for Pension Americans Retirement Company. And we are a retirement planning company exclusively focused on federal employees and retirees. So whether you're just starting out your federal career and you're trying to get a lay of the land, you're near retirement, thinking about filling out paperwork soon and making sure you've done things the right way. You're in retirement and making sure that you're still thinking about things the right way, or you're anywhere in between. We help feds at all stages of their careers. And our goal is to be a holistic, one-stop shop planning solution for you guys. So not only are we experts in your federal benefits, your pension, healthcare, life insurance, all the things that pertain to you guys as feds, but our goal is to finally end that time in your life where you have to go to 50 different people to accomplish 50 different things. So right now, you guys are used to having to go to one person to help you with your mortgage, another one about your taxes. Then you've got your finance guy. Then you've got your expert in your federal benefits. We are here to serve as your solution to all of that. So those are the services that we offer. We've just listed, as well as taxes, tax prep services, home sale, mortgage refi, cheaper insurance, whatever it is, we are here to help you and connect you to these solutions all through the lens of your federal benefits and how to make the most out of your careers. You may have seen us recently featured in some of the below publications. We're really working on getting our names out there. So if you're finding the information that we're talking about tonight valuable, tell your friends. We're looking to spread the word. A few ground rules before we get started. You will be able to ask any questions that you have in the question window. We also highly encourage you to reach out to us. We help people analyze and strategize for their futures every single day. So please do not be shy. Reach out to us, schedule a time to talk, and we'll help you start putting the pieces together. Also, be on the lookout for a survey email afterwards. We're always looking to get feedback, and it's a great place to put your recommendations for future presentations. If you're wanting to see something covered that you don't feel like folks are talking about through the lens of feds, reach out to us. A lot of the presentations we've done this year have been based off of the ideas that you guys have sent us. So, for those of you watching on our webinar portal, this is part 2 of our federal retirement strategies that HR can't share. Numbers 1 through 5 that you see on this screen tonight, or actually in part 1. So if you haven't seen part 1, hop over to that before you watch this one. Tonight is going to be talking mostly about FEGLI strategy, how to make the most out of your survivor benefits, some things to consider there, some things you're going to want to think about when it comes to strategizing your FEHB and Medicare. And then we're going to loop John Mantia in. He's going to start getting into the TSP strategy that you're going to want to think about, as well as the retirement process itself. So without further ado, here is part 2, federal retirement strategies that HR can't share. And the reason that this is that they are limited in the guidance that they are allowed to provide. Sometimes they are allowed to provide facts, but when it comes to being able to tell you what you should and shouldn't do, HR is actually prohibited from doing so. And that's where we're coming in this evening. So first, starting with some FEGLI strategy. We've got 4 main types of FEGLI. This is your federal employees group life insurance. It's offered by MetLife. That's who underwrites this insurance. And you've got 1 fundamental coverage here, basic life, as well as 3 optional coverages, A, B, and C. We're going to talk about some of the ones that can be a better deal in retirement, some of the things you're going to want to watch out for. One thing we're not going to cover tonight is option A. So if you've got option A, and you have questions about it, reach out to us and we will help you. First, let's talk about your basic life coverage. This is your fundamental life insurance coverage offered to you by the federal government. Most employees are automatically enrolled. And a decision you're going to have to make on your retirement paperwork is what you're going to want to happen to your basic life when you retire. You'll take your basic life, you'll take your basic life, round it up to the nearest thousand, and add another $2,000 on top of that. That's the amount of basic life coverage you have. Now, when you retire, you're going to need to make an election on your retirement paperwork. What do I want to happen to this coverage when I turn 65 or at retirement, the later of the two? And so what we're going to do here is we're going to show you an example of DOD Dave. He's going to retire at age 60. His base salary is $74,000. So we know that he has $77,000 in basic life coverage. And we know that this election he makes on his retirement paperwork will take effect when he turns 65. So what he's trying to decide here is whether he should take the full reduction option here, or excuse me, the 75% reduction. This is where you basically allow your basic life coverage to become free. It'll start reducing by 2% every month when you retire until it hits 25% of its original value. That's where it will stay. And you'll have that coverage for free forever for the rest of your life. So what we wanted to model out here is, okay, what does that look like for DOD Dave? Let's say he takes that 75% reduction. He elects for it to become free. That's what most feds decide to do when they retire. And what will happen is he's got 60 more months until his stuff becomes free. So when we map that out, he'll be paying a little over $1,600 in coverage, in premium, excuse me. And after his coverage has finished reducing, it will equate to a little over $19,000 in coverage. You'll see that here. So it's very beneficial for DOD Dave to pay another $1,600 in coverage to eventually have $19,000 in coverage for free for the rest of his life. Basic life is a good deal. For most folks, we recommend they elect the 75% reduction. There are two other reduction options. You'll pay a lot more for them. So what we'd want to do is talk about your life insurance goals there to see if it makes sense that you pursue that. But for DOD Dave especially, it makes sense for him to keep paying for it until he turns 65, let it reduce, and then have almost 20 grand in coverage for free for the rest of his life. Now let's talk about option B. This is an optional coverage. You would have had to have gone out of your way to elect this. And most people typically refer to it as your salary multiplier. So what they're going to do here, you're going to take your base salary, you'll round it up to the nearest thousand, and then you're going to multiply it by something. It's going to be either 1, 2, 3, 4, or 5 multiples, depending on the number of multiples that you've elected. Now, what we're going to talk about in a second is how expensive this option B becomes as you get older. So one thing you're going to want to know is when you look at this table here and you see in your younger years, option B is actually a very affordable way to get comprehensive coverage. You're going to take these numbers here, you're going to multiply it by every 1,000 in coverage that you have. So if you had 200,000, you multiply this number by 200. That tells you how much you're paying for your option B in any age bracket that you're in. So while this is extremely affordable while you're younger, we start to highlight as you get into your 50s, you will notice the cost of your option B really gets expensive. And so we're going to play out an example in just a second of how expensive this option B becomes and whether or not it makes sense to keep it. One thing we want to make sure you guys are aware of before we go into this example is that just because what we model out is going to show that option B actually does become prohibitively expensive and it doesn't make sense for a lot of folks, there are folks where it does, no matter how old you are. And so for that first set that it's really going to make sense for is when you're young. So when you're young, you've got a family, you want comprehensive coverage so that in the event you pass away at a young age, your spouse and or kids are covered. Option B is a very beneficial way to do so. As we know, it doesn't stay that way as you get older, but what other thing you need to think about is how's your health? So if you're looking to replace option B with a private alternative, you're going to want to consider your health. Most private life insurance companies are going to underwrite you. So they're going to want you to pass an insurance physical. If you do not think that you will be able to pass an insurance physical, option B may be one of the only options you have to get comprehensive coverage. So that's an important thing to keep in mind. Now let's take option B, Brian here. He's 57 years of age. He's in good health. So he could maybe consider something on the private market if he wants to, or he could stick with his option B. He makes a little over $59,000 a year. He works for the Postal Service, and he has 5 multiples of option B. So this example we're going to model out, we want to say, we don't want to, sunk costs, everything he's paid up into it to this point. We're not going to consider that, but let's look at what he's going to pay today onwards. So everything we're going to talk about moving forwards is what it will cost option B, Brian, to pay from today moving forward for the rest of his life. And what you're gonna see here is based on these cost tables, we've actually modeled this out. And after age 60 onwards to 80 plus, you actually pay 80% of your total benefit in premium. So we're going to take option B, Brian. He's got $300,000 in coverage. He's 57 right now. And depending on how long he lives, will dictate how much his option B is going to cost him. So if he dies at 67, he'll be covered for 10 years before it pays out, age 77, 20, and so forth and so forth. Obviously, the best deal financially for Brian is for him to die as quickly as possible, because that means he'll have paid the least amount of premiums. Obviously, that's nothing anyone is rooting for in real life. So just looking at it from a financial perspective, as you can see here, with just 20 years of premiums in his 50s, he's paying $100,000 for that. If he lives for 30 years, that right there is his total benefit paid just in premiums itself. And what we really want you to look at here is the average monthly premium. When he gets into his 80s, his average monthly premium is in the $800. This is the trend, right? And so what you're seeing here is that your option B becomes so prohibitively expensive that most folks are forced to drop it. That's what we want to avoid. So some people are like, I didn't need this coverage anyway. We help them drop it at retirement, no big deal. If you're someone that is like, wow, this actually creates a gap in my retirement plan, reach out to us. We may be able to find you a cheaper alternative, but keep in mind, a lot of that's going to be dependent on your health. Now let's talk about option C. This is your family coverage. So you yourself are not actually covered by this. You would actually be the beneficiary. If your spouse were to pass away or any of your children under age 22, each unit that you've elected will pay out $5,000 in coverage for a spouse and $2,500 in coverage per unit per child. You can have anywhere from 1 to 5 units of coverage. The reason we bring this up as you get closer to retirement, and something you're going to want to pay attention to, is that a lot of people actually have option C, but they don't have any insurable interest. So for example, some people only have a spouse, and maybe they've gotten divorced. Maybe their spouse has passed away and they're still paying for option C. If that is you, there is no event that's going to happen where you can collect a benefit for your option C. You are owed a refund. Same thing with kids. Let's say maybe you're divorced and you have kids, or you have kids that have aged out. Only kids 22 and under are eligible for, that option C coverage. So if you have no spouse and kids, and none of those kids are under age 22, you again are paying for coverage that you do not have. And unfortunately, MetLife is never going to reach out to you and say, hey, you're paying for this coverage, you don't have it, you should drop it. They are totally fine with you paying premiums indefinitely, but they are also bound to issue you a refund as long as you reach out to them about it. So if this is you, reach out to us. We pursue option C reimbursements all the time. We can help you get money back on all of those premiums that you were paying where there was actually no one eligible to be covered. So please, please reach out to us if you fall into this boat. And again, let us help you drop this so you don't keep paying for something that you don't have. Now let's talk about some survivor benefit strategy. We're going to focus mostly on the first survivor benefit strategy tonight. For those of you who are CSRS, you've got a more flexible survivor benefit. Reach out to us. We'll help you with it. If you are first, you have one of 3 options when it comes time to retire. You can take a reduction to your pension in exchange that your spouse receives a portion of your pension after you pass away. Here's what it looks like. You can take a 10% reduction. So your pension will be reduced by 10% forever. But in the event that you pass away, your spouse receives half of your survivor benefit or half of your pension for as long as they live. And that's known as the full survivor benefit. You can also take the partial, that's a 5% reduction to your pension, and your spouse would receive a quarter of your pension in the event that you pass away for the rest of their life. Or you can elect no survivor benefit at all. There's no reduction to your pension. But in the event you pass away before your spouse does not receive anything. The first and most important point you need to think about when it comes to your survivor benefit is whether or not your spouse is dependent on your federal health care. If you want your spouse to be able to retain your federal health care after you passed away, you must elect at least the partial survivor benefit. If you do not elect any survivor benefit at all, your spouse will not be eligible to continue your health care after you've passed away. And the reason is that OPM basically needs this pension check from which to withhold premiums. If there's not a survivor benefit check going out to your spouse after you've passed away, there's no way for FEHB to withhold their premiums, and your spouse will not be able to continue coverage. So this right here is the most important factor. If federal health care is something that impacts both you and your spouse, definitely elect at least the partial. Now, for those of you who are asking, well, do I elect the partial or the full? Or, hey, I've got TRICARE or our healthcare is through somewhere else. We don't need this. Let's talk about some of the other pros and cons that go into your survivor benefit strategy. And the way we like to frame your survivor benefit is by comparing it to a life insurance policy. And the reason that we like to do that is that your survivor benefit essentially is a life insurance policy. You pay premiums today in order for your beneficiary to receive a benefit down the line. So when you think about it that way, let's talk about what's good about it and let's talk about what's bad. One of the first great things about the first survivor benefit is that it's COLA enhanced. COLA, we're referring to here as a cost of living adjustment that you get as a federal retiree. That applies to your survivor benefit. That's a great deal. Another great deal about the survivor benefit is that there's no underwriting requirement. So again, if you're in poor health, you were maybe thinking, do I go survivor benefit or life insurance? The survivor benefit is probably going to be a better deal for you because you're automatically approved. It's not quoted to you or based upon your health. And then again, the biggest part of it here, that FEHB continuation. If you want your spouse to stay on your healthcare in the event you pass away, definitely elect at least the partial. Now, for those of you who are like, well, I don't know how important some of these things are to me, here's some things to think about. The survivor benefit has a pretty strict cancellation policy. After you've elected it, you only have a very short window after doing so from which you can drop it. And so you're pretty much stuck in it. You're bought in and you will continue to pay for the survivor benefit as long as you are alive. Whether you decide you don't want to or not, you have to. The only thing that's going to change this is if your spouse passes away. If your spouse passes away before you, you will not have survivor benefit premiums taken out anymore. Another thing to think about is that it's taxable. So when your spouse receives this benefit, they will be taxed on it forever. If you were to think about private life insurance, not only could you cancel it whenever you wanted and not have to pay for it, but it isn't taxed. Any sort of benefit that you would receive would come as a lump sum. Another thing that's better about life insurance as opposed to the survivor benefit is that you can transfer the beneficiary to become someone else with private life insurance. With your survivor benefit, it can only be your spouse. Now, you can initially designate a child under the age of 18. There's a lot that goes into that. Reach out to us for that. But if you're thinking about your spouse and you designate your spouse, that's who it has to stay to. And the reason this becomes tricky is if your spouse passes away before you, unfortunately, you can't redesignate a beneficiary. And so while you no longer have to pay premiums moving forward, you can't change it to someone else and you don't get a refund on what you paid into it. So there's definitely something to the age difference between you and your spouse, the health difference between you and your spouse, and truthfully, the life expectancy difference. Some folks struggle electing the survivor benefit if the non-federal spouse is expected to live a lot longer than the Fed. That kind of changes the equation. And then the last one here, we say structured payout here. I say that this one can either be a pro or a con. It can be a con in the sense that with the survivor benefit, this benefit only pays out once a month. You get it once a month for the rest of your life. With private life insurance, it often pays out in a lump sum. That gives you a lot of money at once to do whatever you want with, to decide how you want to spend the rest of your life. Now, some folks are like, gosh, I don't want to handle that responsibility. I actually prefer more of an income stream. In that case, the structured payout would be a benefit. However, for those of you who would rather get all of the cash at once and then have a lot of flexibility with what you'd want to do with it, the life insurance can be a lot better of a deal there. So again, these are a lot of the things we help our clients walk through when we're saying, hey, how does the survivor benefit play into your overall life insurance plan or your legacy goal or how you want to take care of your spouse? These are the things that we help you walk through every day. Now let's briefly touch on FEHB and Medicare. So your FEHB, that's your Federal Employee Health Care Benefit Program. And one important thing to know is you have to have had it at least 5 years continuously before you retire to be able to continue that into retirement. There are waivers for TRICARE that will satisfy that requirement. But this 5-year rule is really important. If you're thinking about retiring soon and you haven't met that, you are most likely to, and again, I say most likely, we need to know more about your situation, going to want to hit this milestone before you think about retiring. Another important thing to know is postal, you get a unique subsidy on top of the main one. We're going to talk about that main one in a second. But postal employees, you actually get a little additional subsidy on top of that. That's going to go away when you retire. So if you're interested in seeing how your healthcare premiums are going to change in retirement, reach out to us. We'll be able to tell you how that subsidy changes. And then one important thing to know too, and a great benefit about federal employee healthcare benefits is that there's open enrollment every year. And as you guys have just experienced, runs from mid-November to mid-December. And this happens in retirement too. And what's beautiful about it is you can change coverage level, self plus one, family, whatever plan you're in every single year, retirement included. And as long as you're in the federal employee group program, health benefits program, you're eligible to stay into it. It can be Blue Cross Blue Shield, Aetna, Kaiser, whatever you want. Just make sure you're in the program. There's about 230 different plans to choose from. So as your healthcare needs change, you will absolutely be able to capitalize on that. And truly the best benefit about FEHB is that you get a huge subsidy on your premiums. The federal government is paying about 70% of what your healthcare costs are. And so for you guys, your healthcare is significantly more affordable than what anyone else is paying for the same healthcare on the private market. And what's even more beautiful about this is that this subsidy perpetuates into retirement. So compared to most people on the private market, you guys have phenomenal access to really affordable healthcare for your entire lives. And to illustrate this point and how significant of a point this is, we want to show you this 70% subsidy. So this is a huge graph here. There's a lot to look at. It's overwhelming. So what I'm going to do is I'm going to isolate a certain role here. And what I'm doing is I'm showing you guys, okay, if you're a federal employee, your cost per pay period is roughly $200. For someone on the private market, if you're in this unique plan, someone on the private market is paying $667 per pay period for the exact same health plan. Obviously, it's going to vary on the health plan itself, but this is what the differences look like monthly and per pay period for someone who is paying on the private market versus someone who's paying as a Fed. So your federal employees' health benefits are a phenomenal deal. We highly encourage most folks to continue them into retirement. And if you're a military retiree, if you haven't picked it up, pick it up and suspend it right when you retire so you have the opportunity to pick it up later if you need it. There's 4 main types of Medicare. Medicare is so dense, we're not going to go into it much this evening. Please reach out to us about it. Part A is free, refers to your hospital insurance. Part B is medical insurance. That's going to have a premium in 2022. It's $170. It will be based on your income. Part C is supplemental. It's private insurance. It'll be based on the zip code you live in. Most feds never ever need this. Again, talk to us about it. We will go into the nuances of this with you. Same thing with D as in drugs. Private supplemental. This one covers drug coverage. It's going to be based on the zip code that you live in. Costs will vary, plans will vary. Most federal and retirees on average have comparable health drug coverage through FEHB. But again, reach out to us. We'll talk to you about each of these. One Medicare strategy for feds that you may want to consider, if you combine your original Medicare, this would be your Part A, that hospital insurance, Part B, that medical insurance that you pay for, and you've got an FEHB plan, you are setting up yourself to have very limited out-of-pocket expenses. Medicare will kick in first as a retiree. You will exhaust your Medicare if it comes to that, and then your FEHB will kick in after that. Because you have those two coverages, you most likely will be paying very limited out-of-pocket expenses if you run into a lot of healthcare costs. Now, some folks will say, well, that's great if I need it. I don't know if I'm going to need it. I don't know where my health is going to go. And that's a lot to be paying in premiums between Part B and my federal healthcare every month. I'm living on a fixed income. Is it worth it? And so what we see a lot of folks do is sometimes they'll combine a smaller, cheaper, more affordable FEHB plan to kind of mitigate the additional cost that comes with Part B. It becomes more affordable so that they can still have somewhat of a limited out-of-pocket experience. This is going to vary a lot based on the plan you're in. Some have Part B reimbursement programs, some don't. Some people are healthy as a horse and don't think they're going to need either. Talk to us. There's late enrollment penalties. There's plan specific penalties. Definitely reach out to us. This is very dense. And we also recommend watch our Medicare FEHB presentation. It actually spends a full 30 minutes on this. Can be a great place for you to start. Now I'm going to hand over the mic to my colleague, John Mantia. He's the Director of Finance here at Parco, and he's going to talk about some TSP strategy this evening.
Thanks for passing that off, Quinn. And it's always great to see everybody on tonight. And like Quinn said, we'll start talking about some TSP strategies that HR really can't talk about. At Parco, we're fiduciaries, and it allows us, when we service our clients and work with clients, to give them that advice that you can't get from HR. So a couple key things to consider when it comes to the thrift is that it's effectively your 401k, meaning that it's your employer-sponsored retirement plan. Just like any other 401k, it is subject to contribution limits. For 2021, those are $26,000 per year if you're over age 50. For 2022, they're actually raising that to $27,000. So it's an important little extra detail to note. The TSP does have a matching program. It looks effectively like a 5% match. So we always like to recommend to our clients to contribute at least 5% because you're getting full advantage of the free money, the free matching that the government offers. And then another powerful thing and a powerful attribute about the TSP is that you have access to TSP loans, meaning you can actually take out a loan against the value of your policy. This can be very powerful, especially for those who might have high interest debt. Say you have some credit card debt that you're trying to knock out. A TSP loan can be a really powerful financial tool to effectively refinance that debt. And when you pay back TSP loans, you're paying yourself back. When it comes to the distribution options, so when you're working, obviously you can be contributing, and we get lots of questions about, hey, what should I do when I retire? Well, when it comes to your retirement and when you want to start taking money out of your thrift, you have 4 different options available to you: systematic withdrawals, lump sum payments, MetLife lifetime payments, and IRA rollovers. So let's go through each of these one by one. A systematic withdrawal is where you instruct the TSP to send you a certain amount every month. You might say, hey, TSP, send me $500 a month. So TSP will do that. Now, one of the issues with this is that there's an automatic 20% tax withholding. So you don't have control over how much taxes are withheld from those distributions. And in retirement, when you're generally in a lower tax bracket, that might mean that you're over withholding on those withdrawals. Ditto with a lump sum. A lump sum, you can instruct the TSP, hey, send me a $20,000 balance. Send me a $20,000 lump sum all at once. You can definitely do this, but they will automatically withhold that taxes, and it can be really tax inefficient to do so because all of that money is going to immediately show up on your income taxes as income, and you're going to be taxed accordingly. And typically when you have retirement accounts, you want to spread that tax liability out over the course of your retirement. The third option you have available to you is MetLife lifetime payments. If you ever look at the annual TSP statement that you get, this is the number on the front page that might say, you could have $1,200 a month for the rest of your life. If you elect that option on the front of that TSP statement, you are selling your balance to MetLife in exchange for lifetime payments. That balance is no longer yours. We've worked with thousands of people at this point, and I've not ever seen a situation where it made sense for a client to elect that option. The fourth option, which we do see a lot of clients elect, is what's called an IRA rollover. This is where you move your money outside of the thrift into an IRA. It maintains its tax status, be it if you're moving it from the traditional TSP, it would go into a traditional IRA. If you moved it from a Roth TSP, it would go into a Roth IRA. And people do this for a whole host of reasons. It might be because they want more flexibility over their tax withholdings. It might be that they like the investment options that they have within the IRA. It might be that they like the terms or the advisor that they're working with, and they want to have that deeper relationship. Whatever the reason is, you do have that option to move that money outside of the TSP, and that's called an IRA rollover. One of the things about the TSP, one of the hallmarks of the TSP is how simple it is. And for many people, that's a big benefit. And it's been accompanied historically by low fees. So within the TSP, there's 5 core fund options. There's the G fund and the F fund. Those are the bond funds. There's the C fund, the S fund, and the I fund. Those are the equity funds. And then there's the L funds, or the life cycle funds, which are just a combination of those 5 core TSP fund options. Now, historically, the TSP had really, really low fees compared to the rest of the industry on the investment side of things. Well, over time, as the ETF and as the index market has developed, there have actually been a lot of ETFs created that are very close to, if not perfect, analogs of the TSP's core funds. And we get this question all the time. Hey, I want to move my money outside the TSP. What's the closest G fund alternative? Or what's a close C fund alternative? And there are options out there. So something like the IEF or the TLH are relatively close G fund alternatives, at least on the ETF market. And you'll notice that the fee that they charge is pretty close to what the fee is on the G fund. The AGG, which is an ETF that tracks the Barclays Global, the US Global Aggregate Bond Index, almost is a perfect analog or a perfect tracker of the F fund. And you can see the fees are essentially the same. The IVV, which is an ETF that tracks the S&P, actually is cheaper than the C fund on an expense ratio basis. The Schwab US Small Cap ETF, again, almost exactly the same thing as the S fund. And then the MSCI EAFE and ETF, the EAF, EFA, a little bit more expensive, but very close analog to the I fund. The point is that over the past 10 to 15 years, fees, investment fees within the financial world have come down a lot. So whereas the TSP used to really set itself apart with ultra low fees, the industry's really caught up, and fees outside the thrift for investments are at near parity to what you're paying within the TSP itself. So that's some of the basics about the thrift. Now, oftentimes we get a question about on the investing side, how should I be thinking about volatility? How should I be thinking about my investments as I get near or enter retirement? And we always like to point out this example of Federal Frank when we talk about volatility and this idea and concept of sequence of returns risk. So Frank has $200,000 and he's going to be investing in the S&P. We're going to use a 20-year period showing the S&P 500. The first scenario shows if he takes no withdrawals out of his account. The second shows if he takes out $6,000 out of his account, or a 3% withdrawal rate. And this first blue line shows the S&P 500's returns over the past 20 years. So from the year 2000, we used to the year 2019. So start of the millennium through 2019. If Frank had put $200,000 in the S&P, it would have grown to $648,000. That's what actually happened with the S&P's returns. Then we said, okay, well, what if we sorted those returns from best to worst? So the best returns happen at the beginning, the worst returns happen at the end. What would the ending value be? Well, you might be surprised to know this, but the ending value is the same. It converges to the same number. Now, the path that it takes is different. Obviously, it balloons up in the beginning, but it converges down to the same number at the end. Well, this may not be intuitive on its face. This does make sense because the average rate of return of that 20 years, if you take those sets of returns, has to be the same. And since there's no withdrawals being taken out, the end value has to be the same as well. So this is true if the returns happen from best to worst, and it's true if the worst returns happen first and the best returns happen at the end. Again, converges to that same number. It takes a different path, certainly, but they converge to the same number. This is true because Frank's not taking any money out of his account. Once he starts making withdrawals from his account, this whole calculus changes. So this next example shows that same $200,000 initial balance, invest in the S&P, but with a $6,000 annual withdrawal or a 3% withdrawal rate. The ending value is $305,000. So still a nice healthy return, but certainly not as much as if he hadn't taken any money out. Now, if we sort those returns from best to worst, there's a large gap at the end of that 20-year period. Now, why is that? Well, the reason this happens is because during each of these years, as in this example, the account value really balloons, Frank's still only taking out a flat and a fixed $6,000. So that $6,000 that he's taking out in the scenario where the best returns happen first, that $6,000 is a relatively small percentage of his account balance. Said another way, it leaves more of his account balance to compound and grow. So that's what causes this divergence at the end of the 20-year period. Now, while we would love for this to be able to say, hey, look, we want to have all the best returns happen at the beginning of your retirement and the worst returns happen at the end, we can't predict that. And while we love this green line to happen, we really want to avoid the red line. So if the worst returns happen first in Frank's case, even though strong returns happen at the end, because that dynamic worked to his benefit in the green example, it really works to his detriment in the red example, because he starts selling out $6,000 of his balance as the account is going down. That $6,000 becomes a larger and larger percentage of his overall balance, such that by the end of the 20-year period, he's completely exhausted his account. He's run out of money. So when we plan for our clients and do our retirement planning, especially for income and lifestyle and retirement, we're trying to tighten up that cone of returns, this cone of volatility, to avoid those valleys. But we may also not be able to take advantage of nearly as many peaks. Now, some clients say, okay, well, if I want to avoid volatility and I want to be safe, I'll use the TSP G fund. And while it's true that the G fund is safe, it doesn't mean it doesn't have risk. And even on the TSP's own website, and something that you're all experiencing right now, we're all experiencing right now, is inflation. And TSP even says the G fund is subject to the possibility that it won't keep up with inflation. And we're seeing that start to play out. October CPI was up 6.2%, November 6.8%. Inflation is here. The Fed removed the word transitory from their language. Even the Federal Reserve is saying that inflation is here to stay. And while inflation is really picking up, the rate of return on the G fund has been really, really low. It's currently yielding just 1.25% annualized. And as interest rates across the world have really declined over the past several decades, the return that you're getting in the G fund isn't nearly keeping up with where it needs to be. So this is why we find a lot of clients come to us looking for G fund alternatives to achieve that goal, to try to better keep up with inflation, to preserve that purchasing power as you enter and enjoy retirement. So now that we've gone through the TSP and some of the investment things, let's talk about the retirement process. Because, who here hasn't called OPM or who hasn't talked to HR and they tell you it's going to take 60 days, 90 days. We've heard clients tell us, hey, I heard it has to take a year. And so you might have heard that, hey, it takes all this time and effort. And personally, you have to do a lot of planning on your end. You need to decide what your retirement goals are, what your benefits are, whether or not you can afford to retire, maybe do some financial planning and choose the day you're going to retire, schedule a time to talk to HR. You have to do all these things and they all work together. Then when you actually figure all that out on your own, you then have to request your retirement paperwork from OPM. You have to complete that retirement paperwork, maybe with somebody who can help you. But remember, the people that you're speaking with in HR really can't give you advice. They can tell you facts, but they can't say, hey, Frank, in this case, this makes sense. Or hey, Sarah, in this case, for you, this makes sense. The government's not going to take that liability on. So then you complete that retirement paperwork, you might schedule and conduct your exit interview, and then you'll retire. So it can be a really long, drawn out process where all along the way, you don't know for certain the advice that you're getting, or that you're even getting advice that works well for your or fits your goals. And the reason why people talk to us and use us is that if you talk to Parco, we'll put all that context, we'll put all that information around and make the retirement process as seamless and easy as possible. Our company record for getting somebody retired is 5 days. So if you said, hey, John, I want to retire by the end of the month, I'd say, well, look, you're not giving us a whole lot of time here, but we can make that happen. And we make this holistic plan for you to make that process as enjoyable and as easy as possible. And our strategists and fiduciaries are here to help and do this for people every single day. As always, here's a copy of tonight's works cited from tonight's presentation. I want to just again give a big shout out to Quinn for compiling this. The presentations have been great this year, and we're really looking forward to the things that we have coming down the pipe in 2022. Our webinar portal is now live. Some of you may even be viewing this video on our webinar portal, so welcome. If you'd like to link to that, you can just follow this QR code and it links right to our webinar portal. In terms of some upcoming webinar topics that we have, we'll be closing out the year by talking about retirement before 60 and if it can be done. Then we'll be talking down the line about taxes and how some tax changes and proposed tax changes might affect federal retirement. Then we'll talk, one we're really excited about, is why feds are different. And some unique considerations to think about, when it comes to planning and what you might hear on the radio. And then down the line, we'll be talking about some TSP tricks, mortgage refinancing, something we can offer to all of our clients. And then, as always, we'll be doing our monthly retirement paperwork workshop. If anybody needs to reach out to us, we'll be hanging out here in the end of the webinar like always, or you can reach out to us directly on our website, goparco.com, at info@goparco, or on our phone, 833-GO-PARCO. As always, it was a pleasure presenting to you all tonight, and we're looking forward to answering any questions that you have.